I just wanted to talk about how to find areas with capital growth potential here in Australia. And when I'm talking about capital growth potential, I mean capital growth potential in properties. My name is Thomas O'Regan and I'm a buyer's agent here in Australia. And over the last 3.5 years, me and my wife have built an 11 property portfolio. So let's just talk about probably the most important or the most extensive bit of research I do when assessing whether or not to buy a property. And the most extensive bit of research I do goes into finding a location with good capital growth potential. Because the reality is, yes, cash flow is good. Yes, getting a cash on cash return is good. And these are very long-term mindsets you have to think about. But really, where you're going to make a lot of short-term money is through capital growth. That is what is going to ultimately propel your property portfolio and accelerate the growth of your property portfolio, is getting that capital growth. Now, I think about, I assess areas to invest in capital growth a lot different from many other investors, or I guess many other buyer's agents that maybe they're not investors really, they're just buyer's agents that don't have a property portfolio, they don't actually know how to invest, but they know how to buy people properties. I think about it a lot different from them. So I guess I think about it in a counter-cyclical way, like a traditional way of I guess assessing capital growth in an area, or assessing the potential for capital growth is in areas. You just look at the last historical data of that area, say if it's Bondi or Coogee or Waverley or Bronte or wherever it is, or Manly here in Australia, these blue chip areas, and you go, okay, over the last 30 years, I can see consistently that almost like clockwork, the properties are going up by a 7 to 10% rate per year, capital growth rate. Now, I kind of look at property growth a lot different from that, okay? Because the reality is, if you're to build a property portfolio this day and age, and you don't have $300,000, $500,000, or some ridiculously large amount of money, those areas are completely unviable for you. For the first reason I just said, of having a huge amount of capital to start, and for the second reason of investing in a blue chip area, because inherently the areas that are blue chip are so desirable that people are willing to purchase them with the view that they are consistently going up in growth year on year, and they are willing to take the hit on cash flow. What do I mean by that? I mean, effectively, if you're going to invest in a blue chip area, you're getting terrible cash flow. And if you don't do your numbers, you're really not going to make it, okay? Investing in property is all about the numbers. You need to know your numbers. If you are investing in property and you don't think about land tax, council rates, property management fees, CapEx expenses, repair and maintenance of the properties, and a bunch of other things, if you don't understand the numbers, then you won't be investing in property for very long. And the reality is that I'm going to just hit on for the last time with the blue chip asset is the yields on these blue chip assets are extremely low. So effectively, not only do you need a huge deposit to get into those blue chip markets, but you also need huge amounts of surplus income from your job. And me, as an investor, I don't want to have to go and get a job so I can invest. I want to invest so I don't have to work a job. Okay, so it's the way I think about investing is a lot different. So when I look for long-term capital growth potential, I'm actually looking at markets that have underperformed for extensive periods of time. And the good thing about this is most people don't look for these type of properties because they don't really understand how markets work. Markets always fluctuate, and if you look outside of Sydney, where I live, which is something that a lot of people don't do because they're here in Sydney in their little bubble, you'll realize that a lot of markets fluctuate, go up and down, and there's periods of time that can go for as long as 7, 10, 5, or even sometimes 15 years where they have no growth or negative growth. So you really need to deeply understand these market cycles. So when I look at these markets that are going through their cycle, I try and identify at what stage these markets are in their cycle, because the reality is, doesn't matter what stage you are in the market cycle, when it comes to property, and property indefinitely goes up as time goes on. So it doesn't matter if the property in year 1 was worth $500,000 and in year 10 it was still worth $500,000. The reality is, over a long enough time horizon, the property value will go up, okay? Because we live in a capitalist society, and the reality is, in this society we have something called inflation, which means over time prices of everything have to increase. It's impossible for them not to increase. This capitalist society we live in is based on debt and borrowing, and what keeps it all the wheels running is the fact that there's inflation. Okay, so inflation means the prices of everything are going up all the time, and it's not linear. The prices of clothes are going up, the prices of food is going up, the prices of wood, steel, bricks, everything, wages, everything, the prices of everything goes up. And if you understand this, then you can look at a property and say, hey, look, this property that was worth $500,000 in 2010 and is still in 2025 only worth $500,000 has a lot of potential for growth, and a lot of growth, because it has not kept up with the rate of inflation. Okay, so that's the sort of markets that I look to identify to invest in. In short, if I see an area which has underperformed for a while, I try and determine over a 30-year period what was the normal growth rate for that area, whether it be 5%, 4%, 7%, whatever. And I go, okay, that asset type, whether it's an apartment or a house, is performing over a 30-year period at say like a 5 or 7% growth, compounding growth rate. But I've noticed for the last 10 or 15 years that it didn't perform for whatever reason. But the reality is, once an event happens, like an event to trigger that market to go through a cycle happens, the property prices will go up very quickly. And effectively, I want to get into the market just before these events happen, because for one reason, if you get in before these events happen, you have the most potential for upside growth because you can actually negotiate much better prices on these properties, because no one actually realizes what's going to happen. Whereas if you invest in an area like a blue chip area or an area which is already seeing growth, everyone knows and everyone's fairly confident that this is a good area to invest in because it's already growing. Okay, they're just sheep. They're like, oh, growth, okay, let's follow it. Instead of carving your own path out and understanding the fundamentals, that a lot of people just follow trends, okay, follow the crowds. So that's how I assess areas for long-term growth potential. And the reality is, the difference between that and what most people do is, I've taken $45,000 as my initial investment 3.5 years ago and turned it into $1 million in a 3.5 year period, because I've invested in areas which at the start of a cycle. I've seen a lot of upside, a lot of capital growth, and ultimately I've kept recycling that money back into other areas which are at the start of the cycle, and I just keep recycling that money over and over again. And yeah, there's not many people that can say I invested $45,000 and I made $1 million in 3.5 years. So that's the secret to how I've done that. All right, guys, if that helped, just give us a like and a thumbs up and subscribe if you haven't already. Cheers, bye.